Well, good morning, everybody. Happy Tuesday to you. Hopefully, you guys had a good Monday. Mondays are always fun, right? They're always fun. They're always entertaining to kind of get caught back up, especially when you are gone for a week. Then it gets really, really chaotic. It gets really, really difficult. Good morning, Kevin. Glad you're here, my friend. Welcome in. Welcome into the live stream today. It's going to be a good one. I got 4 articles. We'll see what happens. You know how it goes. Sometimes I get through them all. Sometimes I don't. That's fine. It's just all part of just socializing, having some fun, kicking back, talking about real estate news, all the fun stuff. Let me know what you guys were up to yesterday. Anybody have any closings, good showings, unique houses, unique challenges? Let me know. Let me know in the comments what your day was like yesterday. Mine was just a catch-up day. I had a few meetings, a few things I had to get done and that kind of stuff. Oh, one thing I'll talk about, I'm not in the market for a car by any means. I'm not in the market for a car. But this, have you guys seen this? And this is not, we're not into the show yet, right? So you've heard of the Rivian, right? The Rivian car, the Rivian car. The Rivian car, I think it's like an Amazon sponsored type car manufacturing company, I believe. But like they put out a new car. It's called the Rivian 2 or the R2. And it's like this really big, it's actually a mid-size SUV, but a lot of space in it. It's kind of cool. But it's like electric. It's an electric car, 350 horsepower, 5.9 second to 0-60 for the base model. Starts at only $44,999, $90. It's kind of interesting. This whole world, I'm not leaning to buy a car or whatever. It just popped up in my YouTube feed this morning. I watched this introductory about this car and shipping now, and they were hyping it all up and stuff like that. But it's kind of a cool looking car. I'm interested in it. It's neat. They have a premium performance. The top end model is like 57,000, but like that sounds like a lot. But nowadays that's just not that much. Like we have a Toyota Sienna for the family, like our minivan, and they start at that. I mean, like they're all above like that amount. So it's like, yeah, for this kind of vehicle, it's really not that expensive. Got all kinds of cool little tech in it. So I went down this whole rabbit hole about this car. It's like, that's what I did. I did that this morning. Just got to looking at this car. It has all kinds of cool features. It's like outdoors and rugged and all-wheel drive and has tons of storage and all this kind of stuff. I'm just fascinated with where electric vehicles are going. I just don't know if we're there yet as far as the infrastructure goes. If you guys are just logging in, this is the part of the show where I'm just hanging out and getting things started. So, this is about cars right now. If you're out there and you have an electric vehicle, let me know. Anyway, I thought it was really cool. I thought it was a cool car. All right, guys, real quick before we get started in the show, I'll tell you a little bit about what I do here. Just so those, if you're new and you've not been here before, you know what it is that I do. Basically, I log on 8:30 a.m. Eastern time, Monday through Thursday when I can. And I do about an hour live stream. I bring in the real estate news. I go through some just news articles about what's happening specifically in the real estate industry. And I kind of dissect it, give you my opinions, my observations, that kind of stuff. And then we discuss it in the comments. So you guys are welcome to do that. Join me in the comments. The way I like to do this is like if I'm doing an opinion piece and I'm talking through like an article or whatever, and you have a comment or you have a question, even if it's off topic, I don't care. Feel free to do that. I've been doing real estate for over 20 years. I've done everything from commercial to residential to farms to auctions to everything. So feel free to ask me any question you like. I'm a licensed broker, so it's what I do. So feel free to ask questions. Also, you can ask questions about the article or experiences that you have. I love that. Feel free to engage me. I like doing that. That's why I do live streaming. That way it is interactive and we can talk through things. So feel free to do so. Feel free to do so. All right, with all that being said, making sure my feed is going well. Looks like, let me see something real quick. Let me know if you guys can hear me or not. Technology sometimes can be a little squirrely, and I'm wondering if I'm having an issue. I'm getting a warning sign. My internet has been kind of slow today, and I don't know why. So let me double check something real quick. It shows me live. Okay. I think we're good, right? I think we're good. All right. Yeah, good old technology. What do you do? Okay. All right. With that being said, guys, let's go ahead and jump into today's show. Today, I'll do the introduction here in just a second, but give you an idea about what we're going to be talking about. I've got a quick little snapshot in regards to July 2026 monthly housing trends. List prices fall as homes sell faster. It's an article by realtor.com. And oddly enough, all three of my 4 articles are all coming from realtor.com. I don't know why, but that's what they're doing. That's the first article. Then we're going to go into why homeowners who did everything right may be headed back to the starter home market. We'll talk about that as well. And then survey, nearly 9 in 10 agents believe buyers benefit from independent representation, access to every listing. So it's an article talking about, just kind of getting a poll of what buyers are looking for and what agents' opinions are in regards to buyers. That's what that article will be. That's by PR Newswire. And then we'll end. This is going to be a fun little one to end with as like a little icing on the cake, if you will. It says the extraordinary real estate of the founding fathers would be worth hundreds of millions today. So we'll look at George Washington's house. Let's see what else is in here. Who else did they have? I've not actually read this. Thomas Jefferson's house. And really, John Adams. So it's just an article talking about like, what would their home be worth today if it was on the market? Kind of a cool little conversation. Alexander Hamilton. Yeah. So anyway, we're going to just have a little bit of fun at the end of this live stream. All right, so hang with me, join in, chat with me, talk, all the above. Let's go and get started. Welcome to the Real Estate Brief. I'm Adam. Today we're going to be cutting through the noise. We're going to get to the truth in the news, look at the data, and I'm going to give you some of my observations and where I believe you can find opportunity. So if you're ready to gain your real estate edge, let's dive into our very first story. And this first story is really very specifically about the market. Now, I know it can be kind of boring to do that. I did that yesterday as well. We talked all kinds of numbers and statistics and things like that. But I will say, if you're interested in that kind of stuff, which you should be if you're in real estate, go back and watch yesterday's live stream. And I broke down a lot of things that the projections are and what that looks like. Go back and watch yesterday's. Today, we're going to be talking about list prices fall as homes sell faster. Interesting, right? So this article is by realtor.com, written by Jake Krimmel, August 3rd, 2026. Let's jump into this article. July 2026, monthly housing trends. List prices fall as homes sell faster. Market outlook. It says, July began where June left off. A gentle steadying with modest mortgage rate relief and news of inflation ticking down. But that more settled backdrop did not last for long. The conflict in Iran reignited oil. Oil crossed $100 a barrel for the first time since May, and mortgage rates reached 2026 highs with inflation pressure bubbling under the surface too. These are the same shocks that hit the housing market earlier this year, but the timing is trickier this go around. Spring's geopolitical shocks and economic fallout hit a housing market with seasonal momentum at its back, while this summer's flare-up arrives with no such tailwind. The reality is, yes, this market, we were on a trajectory to have a little bit more of a rebalancing take place, and then you had the Iranian war kind of trigger off everything, and it just threw the economy kind of in a, I'm not going to use the word tailspin, even though I just did. But the reality is it's not a tailspin, it's just a odd one. It's hard to predict when you have this kind of stuff going on. And the oil prices is obviously a big factor in interest rates and the overall economy of America, right? So it's just been volatile. It's really hard to kind of pinpoint what's actually happened in the market when you have some things like that going on. So that's where we find ourselves. Like we can make all the projections in the world, but then the world itself changes what those projections would be. And that's what we're having, right? The Realtor.com data showing market coasting, but not outright decelerating. Asking prices fell for a 9th straight month. Homes are selling a bit quicker than a year ago, and pending sales grew for an 8th straight month. This comes even as the growth cooled and price cuts crept back toward last year's levels. Nothing in July looks like last summer's seller retreat, but whether we are in a normal season slowdown or something softer will become clearer next month. Now, so this is true. This is all very true. They're using data to say this, so I can obviously confirm this, but the interesting thing that happened with prices is, I've actually noticed this in the data. There has been month over month a slight decrease in value in homes. A lot of homes that are priced in my area $400,000 or $500,000 are sitting on the market for a lot longer. So they're trying to get closer to that $300,000 mark, and that helps them to move faster. So if they're really close to that 400, you get into the threes, it tends to sell a little bit faster, is what I'm noticing in the data. So It's just a weird thing. It's like there's a price adjustment happening, but it's not drastic. It's probably just coming back down to where it really needs to be to adjust to where that affordability gap is, income is at, and those type of things. We're getting into another thing too in regards to purchase prices and where homeowners currently find themselves. That'll be our next article. All right. It says July's top storylines, according to the data. We talk about asking prices fell for a 9th straight month at a near record pace. It says median list prices dropped 2.4% year over year, following June's record. Since 2018, 2.5% drop. Price per square foot fell 2% and is now declining in 34 of the top 50 metros, up by 1 from last month. So I just feel like this is just a normalization of the market. We had this crazy inflation going on. We've had this, we've been in the, like if you go back just a few years, we were double-digit appreciation, and it's been dropping since then. And with us sitting at like 2.4% year over year, what the Feds typically will look at is they want that to be as close to 2% month over month, and then the interest rates adjust accordingly. So if we're above 2%, typically they either hold or they could even increase given any kind of volatility in the market. So like the Iranian war. So since we're still sitting at a higher inflation rate above that 2% threshold, you add the Iranian war on top of that, prices will then begin to fall. This is supply and demand. This is income. This is job growth, all those type of things bundled up into a number, which is called the interest rate. So that's what we end up seeing. Price cuts are converging with last year's pace, led by a surprising pair of regions. The share of listings with a cut hit 20% in July, just 0.6% points less than in 2025 after running nearly 2 points below it all spring, notably the Northeast. And some are slowing on schedule. Nothing crazy going on there. Now, here's some key questions. This is the part of the article I'm going to kind of get to, okay? The question is this. Mortgage rates are drifting back up, and oil prices recently hit their highest levels since May. How will the housing market handle renewed pressure in the second half of 2026? And it says this. The first half of 2026 was a story of initial promise, followed by resilience as the housing market fought through inflation, economic uncertainty, and a mortgage rate roller coaster. Is that not what we were talking about here? Like if you were to go back and watch January's live streams, you'll hear me talk about, and all the economists were talking about how hopeful they were for 2026. And they were talking about all these different projections. And guess what? They're just projections. That's what they are. They always are. They are projections based on what we know in the moment. No one could have predicted what is going on in Iranian war. They couldn't predicted that. They might have had assumptions. They could have made assumptions about that, but you cannot predict that external, situation that causes undue pressure on an actual, economy of a country. You just can't do that. And so that's what we begin to see here. All right. In June, we said we judge a potential summer slowdown by 3 tests: home sitting longer, price cuts accelerating, new listings pulling back. What's the verdict? The jury is still out. In other words, we can't predict. There are no signs of time on the market increasing, but price cuts are creeping up and new listings have pulled back. We have seen this in our market. Let me know in the comments if you guys have seen this in your market, but I have seen this. I have seen that listings that are going on the market are coming in at a very competitive rate. They're coming down just a little bit in their price. The average listing price has come down as well. And then the days on the market is sitting kind of about the same. So that tells you that we are still in a price adjustment market. That's still what's happening here. The key is to read metrics together, especially within the same markets, rather than in isolation or at national levels. If price cuts lead to sales and steady time on the market, they are not a warning sign so much as a marker of a rebalancing toward buyers. A key takeaway from our 2026 second quarter market clock report. And that's absolutely true. Price cuts are an indicator. They tell us if they kind of rebalance the market a little bit, and the longer we hold that, it's not a warning sign that something's crazy going on. It is just that rebalancing. The reality is economists actually thought that rebalancing was going to happen a lot sooner, and it didn't. It actually pushed farther forward. And that really has to do with that affordability gap and income and all that kind of stuff not really catching back up. So it's just kind of taking a little bit longer to rebalance, and you got the other things going on. It says, what should we be monitoring heading into August? Price cuts, pending sales, and delistings in tandem. So that's good advice for you guys as real estate agents. Like, what should you be watching in your market to help you stay informed about pricing homes correctly for your sellers to help move the property faster? It's looking at what's going on as far as like price cuts are concerned. So go into your MLS, pull up data, and look at the history reports on properties and see where price cuts are happening. See what might have been listed at one price, how long it was at that price, and then when it was actually decreased in price. Those kind of price cuts help you see a broader picture about what's going on in the homes that you're listing. And it's good information when you're going in to talk to a seller to understand those kind of data. Now, here's the thing about data, and I'll just pause for just a second here, is with data like this, the first time you look at it, you might not see any kind of pattern. At that moment, when you're first time doing any kind of statistic reading or looking at data, your goal at that point is just to absorb that information, take it and digest it, and then systematically go back and check that data consistently. Because what will then, show itself is a pattern. And the more you look at that kind of data, the more things you kind of begin to see. And that's what you've got to get to. You got to get to the point where you can read the numbers. And the only way you can read numbers when it comes to statistics and markets and that kind of stuff is by consistently going in there and looking at those things. That's how you begin to see them. So you want to look at price cuts. You want to look at the pending sales. Are they going up? Are they going down? What does that look like? What about delistings? Okay, how many homes either expire or go on the market and go delisted and do not sell because of it not moving or not getting the activity? What does that look like? Those are indicators that the market is still kind of resetting and gives you an idea about where things might be heading to help you make better projections and help you also have better listing appointments with your sellers. Okay, those are very important details. And what they're saying here is those are the metrics that you should be watching. I would agree with all of those. Yeah, and it goes on. Those three were the hallmarks of last year's cruel summer. Sellers cut prices at the highest rate in our data's history. Pending sales fell anyway, as buyers largely said, no thanks, and delistings surged as sellers gave up. As of July, all three are performing better than last year, although price cuts are creeping up. August data will tell us whether we're in the midst of a normal seasonal slowdown or if all three are moving in the wrong direction, the beginning signs of a stagnant market. So we'll revisit this at the end of August. We'll go back, we'll pull this report, and we'll see what's actually happening here. Like, what can we see in the data? Okay, so that's what we'll do. You can get all these articles, by the way, in my YouTube description. All these articles, the links to them are there. Go, feel free to do that. You can search for the Real Estate Advantage, look for a photo of myself, or go to youtube.com/the Real Estate Advantage, and you can see the live streams there with all the links to these articles. And therefore, you can get into the data a little bit more. You can go through here and just read all this if you want to get into the data, which I encourage you to do, guys. I encourage you to get in here and see this often. And just so you know, the Realtor.com does this all the time. They do data visualizations. They have data library. They have videos. It's under the research tab. So news and insights, and then I think it's in, research right here. News and insights. And when you click research, it starts giving you up immediate statistics and data, and then it gives you articles, and you can keep tabs on this. And they do a great job of it. I mean, they really do. They do a great job pulling in a lot of data. Okay. All right. Let's move on to our next article here. Let's see. This next one here is, again, by Realtor.com. It's kind of piggybacking right off of what we just talked about. It's nothing too drastically different, but it does give a different perspective. So that's why I piggybacked it onto here. So let me scroll down. Here we go. The why homeowners who did everything right may be headed back to the starter home market. Very interesting headline. It's by Eric Goldstein. All right. Quick drink of coffee, guys. Get your coffee. It's early. Potential home buyers seeking their next place to live are no strangers to competition, especially in a market where rates feel stuck above 6%. Prices hit record highs, and housing supply is hard to come by. So they're setting the stage. Here's the scenario. Here's what's actually happening, and where do we go from here? But according to experts, a new type of competition may soon emerge at the bottom of the market as three different types of buyers start looking at the same sliver of housing stock. And that includes a brand new buyer segment that likely never expected to be house hunting today. Now, this is where, when I say at the very beginning of my headline or my introduction to my show, where I say I help you find opportunity, this is part of that. When we go through any kind of market shift like this, you basically have two options, okay? You have the option to buy into any headline that is negative and run with that rhetoric and talk about that with your office. The second one, though, is to adapt what you do and take advantage of the opportunity that is right in front of you. And that is by reading, understanding, comprehending, researching, and then executing. And those type of things is what's going to help you be able to be successful, because you are in an industry that changes. And I want to say this almost every stinking single day, at least every month. So be aware of that. There is opportunity here. So let's pay attention about what's actually happening here, because we're going to see a buyer segment that we might be able to take advantage of as real estate agents. So let's pay attention. Let's read through this. Which of these three buyers comes out ahead won't just come down to who bids the most. It'll come down to who can close the cleanest, fastest deal. All right, a new type of competition. Now, let's put our strategic thinking hats on. Think about marketing and what we want to do as real estate agents, okay? A new type of competition. One story, low maintenance, and modestly priced homes have long been sought after by first-time home buyers, as well as older people looking to downsize, says Ashley Harris, Director of Homebuyer Education at Neighbors Bank. Okay, that's true. If I was to look at the standard, let's just say a standard ranch home, 3 bedrooms, 2 baths, right? Single level, usually on a typical lot in a subdivision, okay? That would be what you would say would be the typical first-time home buyer would be buying those homes. Then people start having kids, start having families, and they upsize from there, they build, or they buy a bigger home. But then they revert back to that as they get older, and they go back into a lower maintenance type of home, okay? So that's been the typical trend as long as I've been in real estate. That has been kind of what people look for. Now, given it's local, your market might be completely different. But anyway, that's the majority of people. Now, what does she say? She goes, but from her vantage point, she's seeing new layers of complexity in the competition. Here's her quote. It's not like we're short on houses. We've got plenty of big, older homes that cost a fortune to keep up. What we don't have is that smaller, right-sized home that a first-time buyer or somebody downsizing wants. And a lot of that is because builders kind of stopped making them. This is very true. In our own market, our builders were building these 2-story big houses, full walkout basements, pricing in the $600,000, $700,000, $800,000 ranges. And they quit building these more starter type homes. And there's many reasons why that would happen. You know, a lot of times the bigger the house, the builder can kind of help curb costs and usually turn a little bit of a higher profit when the buyer market is there. The problem is the smaller the home, the tighter those margins get. So they would tend to fall into the trap of building a bigger house. But then now the buyer has kind of shifted. And what are they looking for? All right, builders are incentivized to build bigger and nicer homes that cost more money as a way to pad their bottom line. Yeah, here's what. So while there is an overall housing supply crunch across the country, it's going to be more difficult to address the issue at the bottom of the market. First-time home buyers who are getting older, this is a key thing too, guys. Like I mentioned this yesterday in yesterday's live stream, is the median age for starter homes or first-time home buyers is hovering right around 40 years old. Isn't that wild? That's wild. But it's because the cost of home versus the cost or the amount of income somebody's making is so broad. And that's causing that problem. It says we're already feeling squeezed by affordability, rates, and repeat buyers leveraging their accumulated home equity to make big cash offers. Now they're having to contend with all of that, plus a new type of home buyer who has emerged in recent years. Now this is where it gets a little bit interesting. Quote, it's people who bought back in 2021 or even before that who purchased a home they thought they could afford. Okay, that's the demographic. They bought something because they thought they could afford it. Because why? It probably had a very low interest rate, 3%. But it still means their payment was still very high. Even though a majority of it was going towards equity, it's still a very high payment. It says these folks who did everything right? They looked at their budget, they looked at their affordability, they bought this house, they have a low interest rate, and they bought what they needed, okay? They did everything right. Are still being pushed back into the entry-level market by rising cost of ownership. Now, this is probably going to get into the whole idea of maintenance. And this is where I've been at. It's like if somebody says like you've been locked into a loan because you have a low interest rate, well, you might still have a house that doesn't fit your needs. So you might, if you look at it through the one lens and you say, well, I've got a low interest rate, I don't want to ever sell. Well, if that's the only lens you look through, you ignore the majority blaring other issues with that statement. And that is the overall cost of maintaining that bigger home that you might not need just for the sake of a lower interest rate. So things like your utility bills, maintenance, right? Those things drive costs up and they are more expensive. What about taxes and insurance? All those things drive the cost up. So you got to do the math and make sure that's what's happening. So that's what she's kind of talking about here. They did everything right. Everything was right. They built great equity. They're sitting on great equity. But now they've got a home that's actually costing them more that they might not need anymore because kids may be grown up and they moved out in the past 5-6 years. And now they're needing to downsize. Where this third buyer comes from. If you're a current homeowner, you might recognize that description. Even if you bought a home with a mortgage at 3%, a confluence of rising costs may be eating away at your affordability. That's exactly what I was just talking about. Quote, we've had sellers tell us the mortgage isn't what's pushing them to move. It's everything else, Daniel Amedio, president of Ammo Realty. He points to Florida as a market where this new pattern stands out. He quotes, between higher insurance costs, HOA fees, and just general maintenance costs, some people are deciding they'd rather own a smaller, less expensive home. It makes absolute sense, guys. This is why, as every month and every year that goes by, that term lock-in effect, matter of fact, I've not seen that in an article in forever. That was a big thing. People are locked into the loans. That's becoming a non-issue now. It's becoming a non-issue because their life circumstances dictate what people do and what they buy, not necessarily the interest rate. It's a factor, but it is not the factor. And this is the point that they're making in this article. And what we're again thinking of is who's our demographic? Who is the next wave of buyers? We're getting an idea here. We're getting an idea of who the next wave of home buyers are going to come from. Why? Because these people have equity in their home. They have a house they don't currently need. And what does that mean for us as real estate agents? We get a listing and we get a buyer. And we got buyers that have the cash to be able to buy. That is a great demographic. First, there are property taxes, which are reassessed every few years and based on home values. If you bought a home for $400,000 and it's now valued at $800,000, get ready to see a massive difference in your tax bill. Yep, that's what happens. Harris says that property taxes climbed about 30% between 2019 and 2024, and the average single-family bill reached roughly $4,400. This can happen even after the market has cooled due to expiring tax relief, new local tax rates, and other factors. Now we go into the next one. Insurance is also a well-known source of carrying cost woe. Homeowners policies are skyrocketing. Who has not had their insurance go through the roof, right? This is a big factor. Insurance is increasing in cost. And so that is another reason that people have a bigger home. Even though they might have a 3% interest rate, the cost of maintaining that home is skyrocketing with all these other things being increasing the cost of that house. So they might move. Taken together, the escrow account that your lender manages to pay for taxes and insurance may suddenly require a higher payment, plus additional cash for last year's shortfall. There's one viral video from last year featured a homeowner whose taxes had been assessed on the land alone, missing the home itself, leaving her with a $23,000 escrow shortfall that nearly doubled her mortgage payment. Now, I will say that is going to be a very rare case. That is like finding the most extreme case in the world that you can think of to prove your point in an article. I'm not saying it didn't happen. I'm saying it probably did happen, but I'm saying that's probably a little bit of a drastic increase. I've not seen that, but I do see a lot of things talk about going up. Harris calls these escrow leaps the black ice on this market. She's already seen accounts climb by $250 to $500 a month in some cases and expects it to become more common going forward. I will say I've seen that. I would say I've seen around the $250 mark that it's going up that much to adjust for escrow, taxes, and insurance and things like that. So I would agree. Somebody who felt totally fine with a $2,500 payment might not feel fine at $3,000 a month. And now they're looking for something that frees up some of their budget. Now, this is the thing. Like when you start thinking about this, who's your clientele? If I was to sit back and think through, if I was going to advise real estate agents on where to find listings and buyers, I would take this kind of data and I would lean very heavily into the idea that looking at homeowners that bought back in between 2020 and 2023 and looking at them and assessing what they paid for that house, because go back and look at interest rates over time, right? Let's go to this. Let's just do this. Mortgage News Daily. Okay, let's just pull this up, which I don't like looking at these interest rates right now because it's kind of depressing a little bit. Oh, they went down 0.1%, 0.01%. But the reality is here, if we go here, let me do this. Let me zoom in. We're going to try to get this to position itself if I can. Yeah. So we go here. Okay. Look at this. Look at this rate right here. Okay. This is back in, let's see, 2019, hovering around 4. Then anybody that bought in 2020 specifically. All right. Look at 2020. All right. Let's just jump in there. February 17th of 2020, interest rate was 3.46%. All right. All the way down into 2020. If you get down to here, okay, here is the lowest amount. So here's what you could do. If you want to find a good area to market yourself to and get listings from, this is where it's at. You go here and you say, look, in December of 28th, 2020, interest rates around 2.78. Okay. They have a very low interest rate. You would think they're locked in, but you go from 2020 to 2026. Okay. 6 years. Now, I want you to think in context here. If somebody bought a house in 2020 and they bought a big house, chances are they had kids. How fast do kids grow? If they would have bought a house for a family that had 12, 13, 14-year-olds, guess where they're at now? They're not at home. They're at college. Maybe they come back. Maybe they don't, right? So there's a span of time. And their home has now appreciated for 6 entire years. Okay, so now they're sitting on a good chunk of money because if they bought in 2020, they've got a huge amount of equity. They've got a massive amount of inflation on their property. Therefore, the value is there. So if they were to sell their property, they're taking a huge chunk of cash and they can roll it over into a smaller home that fits their needs, right? So if you're looking at your sales market, go into your MLS, pull sales that took place between 2020 or 2019 and 2022, and start marketing yourself in those subdivisions and find out where the opportunity rests. There's opportunity just sitting right there. And it's in the talk track about this is not looking at the interest rate. It's not talking about, oh, especially if they say, well, yeah, my interest, I have to go refinance and I'm going to get an interest rate of 6.5% or whatever it might be, or almost 7. But you need to explain to them, it's like, yeah, but you're also taking the equity of your house. You might be able to buy a house and not have a loan at all. Or if you do have a loan, it's going to be a very small amount, regardless of that 7% interest, and you're paying less in taxes, less in insurance, less on home maintenance. All those type of things go down. So you got to do the math for them. But there's opportunities sitting right there. And a lot of agents are not going to go there because they're going to assume that because that person has a low interest rate, they're not ready to sell. That's a mistake. And that's what this lady's arguing from. She's making the point to argue from this article that there is a buyer pool of market right there, sitting and waiting. That's where the new buyers are coming from. Who is best positioned to win the battle? Now, some short change buyers are seeking to downsize or resize alongside older cash flush buyers and those who have finally scrapped together enough for a down payment. Think about this. You've got, if this person's wanting to downsize and you've got the new freshly out of college buyer, they are trying to gather up all their funds. They're trying to look appealing to a seller and they're trying to make offers. And then you've got somebody that has a lot of equity in the house, sold their house and has cash. Who's a more eligible buyer, right? That's the argument. These home buyers are re-entering the market at a time of higher interest rates, but they are able to make significant offers thanks to the equity in their home. That's especially helpful if they're looking at a different market. We've seen homeowners in Florida who bought several years ago when prices were much lower benefit from appreciation. They're able to sell, relocate to more affordable markets like Central Georgia, and in some cases, purchase their next home outright with cash. Here's the next phase. Okay, so there's another opportunity, if you read between the lines here, is if you are in a certain area, you can research and pull data to see where the majority of the people that are moving into your area are coming from. So if you have a higher percentage of people moving into your area from a specific location outside of your area, there's a demographic to market to. It's also a place to reach out to other realtors in that area and build a referral type system up with them. Another opportunity to take advantage of this demographic that is downsizing. It says, but every home buyer segment brings an advantage to the table with them. And those who are seeing this dynamic play out say that the winner isn't always so clear. When these groups compete, the buyer with the strongest overall offer usually wins, not necessarily with the one offering the highest price, says Mikhail Kelzawiski. Sorry if I butchered that name. A real estate broker and loan officer. A buyer with conventional financing, a solid down payment, limited contingencies, flexible closing terms, and a reputable lender is often in the strongest position. So again, you're getting the ready, willing, and able buyer is what you're getting. First-time buyers should take heart because, as Harris says, they can write the cleanest offer. If you're renting right now, you don't have a house you need to sell first. So there's no contingency hanging off your offer. So a first-time buyer who can stay flexible in timing may maybe even offer a short rent back can beat a higher offer that has the condition attached. So there's still opportunity. Let's see. You get the idea. I don't want to relabel that anymore. But this is the thing. It's like when you start looking about what the market's doing, like we just went through like the actual realtor.com research data, talked through about what's going on in the market, made some assumptions about it. And we jumped specifically into an article that's giving you some opportunity to find out where the buyers and sellers are coming from. Those two articles together, combined with the knowledge about what's going on in the market, will help you price properties correctly. So when you go in to have the meeting with this very good pool of possible listings and buyers, you have the talk track you need to price it correctly, and you have the opportunity sitting right in front of you. That's where we're at. This is another reason to stay in this news. Like a lot of agents do not take the time to read this news every single day. But when you do, when you start doing this, you start seeing patterns. Those that I can see, Bobby and Michelle and some of these regular ones that come in all the time, hopefully you guys are starting to see trends. Like you guys are here all the time. And Kevin, you guys watch these type of things. And just like I'm doing, you guys are being diligent in your careers and you're learning. And every single time you watch and learn something, it kind of adds to that information bank and it helps you to navigate the shifting in the markets. It's just a good discipline to have. But at least we get to do it together, right? We're not doing this alone, which I think is fun. All right. This next article here, I'm going to do this for about 10 minutes. I won't spend a lot of time on this one. And then I want to get to something just kind of fun. This is a survey done by Zillow. Love or hate them, whatever they still do research and stuff like that. It says nearly 9 in 10 agents believe buyers benefit from independent representation, access to every listing. Richard, thank you for commenting, my friend. Richard Laurent, lots of shifting for sure. Yes. There's a ton of shifting, man. You know, and that's the whole challenge, to be honest, in this industry. And that's why I lean so heavy and I encourage all agents to stay in the data. Look, I understand it's boring. Trust me. There are days I was like, oh, I have more numbers and I got to read this again. It's the same old, but it's not. It's very, very important. The data is the truth in the market. So we can navigate these shifts that Richard's talking about better if we stay in that data or if we read these type of articles. And just like we demonstrated, just like we just talked about, is it not opportunity? And so you can read headlines. I have found that even when the headline is negative, like when the headline says, oh, foreclosures are increasing, or, you know, the market has shifted and now it's the buyer markets is tanking, or the seller's market's tanking, or whatever the case may be, whatever negative article it is, okay? Again, we have two options. We can just buy into that hype and just buy into the negativity, or we can pause and find the opportunity, because I'm telling you, been doing it for a long time. In every market, there's an opportunity. You just got to be willing to shift with it. And you got to let your ego and pride go to the wayside. Because what I saw when I first got into real estate, let me give you a scenario here. When I first got into real estate, I got into real estate like back in 2005, 2006, okay? 2005. When I got in, it was the beginning. I mean, it was a great market. I was like riding high and I mean, selling properties, all kind of stuff, right? Because I got into the peak. Then it crashed, all right? And I found opportunity in the foreclosure market. And I found opportunity there because the agents that were used to selling all these homes and having all these numbers had a little bit of pride. They didn't see the opportunity sitting right in front of them in regards to foreclosures. They didn't want to work hard to deal with short sales and negotiate with banks and put all the time in to convert properties over. They didn't want to do it. So I sat back and I said, I'll do it. And then we began to do that. We began to do the HUD homes and everything else. And that's the opportunity. So in every market, don't buy in and get prideful. Shift with it. Go along with it. Don't just be rude and say, well, I'm just a luxury agent, or I just do commercial, or I just do farms. Look, you're in real estate. Market shift, and you got to be ready to shift with it. That's just the way it works. Eric Gonzalez, have you seen agentfomo.com built by realtors? I have not, Eric. I have not seen that. I'm not sure what that is, but let's just, I mean, Agent FOMO, that's actually pretty funny. Agent FOMO. Agent FOMO is live. Claim your profile. Your profile may already be waiting. How Agent FOMO works. Okay, let's just, hey, you brought it up, man. Let's talk about it. It says, claim, update your profile with your license, photo, bio, and service areas. Get found. Show up when agents search by location, specialty, and fit. Refer. Send referrals, negotiate terms, and connect clients with the right agent. Interesting. So is this a lead aggregate? Does this help with leads? I don't know. Is that what it does? Stop hunting for a random agent. Agent FOMO gives licensed agents one place to find, vet, and connect with referral partners. Oh, gotcha. Yeah, very cool. Sure, I'll dig into this, Eric. The client aggregate. Yeah, the client. Yeah, very cool. Yeah, let me know like how you found it. Are you connected with it, or what's the connection there? Or did you just find it? Are you using it? Like, kind of give me your feedback on that. I'd like to know about that. So, guys, Eric Gonzalez has brought up a website. It says agentfomo.com. Agent FOMO is live. Claim your profile. You built it, Eric. You built it. Nice. 25 years in the business. Eric, awesome. Thank you for the shout out, man. I'm glad to give you a shout out of this. I will actually log in and check this out for you, man. Absolutely will do that. But there you guys go. A little shout out for Eric, and thank you for commenting and joining the live stream. So agentfomo.com. Check it out, guys. I will do likewise, my friend. Absolutely. You're welcome. That's awesome, man. I love it. That's what makes this live stream so cool, guys. Like, I mean, sometimes I feel like we fall into some things I didn't know about. Like yesterday, someone suggested Kimmy K3, the AI, and I began kind of researching that a little bit yesterday as well. So this is the beautiful thing about a community of real estate agents, is like everybody kind of has different ways and different doing things, and it's really good to connect that way. So I would not have ever found this, Eric, if you hadn't taken the time to make a comment, buddy. Appreciate that greatly. All right, let's jump into this article here, and then we'll jump into something fun. Nearly 9 in 10 agents believe buyers benefit from independent representation, access to every listing. New Zillow survey finds agents overwhelmingly agree on what's best for buyers, even as financial incentives drive some in the industry to push private listing networks that work against it. Now, I'm going to just pause for just a second here and just set the stage a little bit. One is, this is by Zillow, and everybody knows Compass and all them are in this feud about private listings and what that all looks like. So the reality is Zillow is gonna have to work their angles into this. And here's the thing: is I'm probably not going to disagree with their survey results here. Like I'm probably not, because they're looking at it from what perspective? A buyer's perspective. Okay, so therefore, yes, if I was representing a buyer, the private listing network would not be the best for my buyer. But then the flip side of that, that's not the argument that Compass and MRED, the largest, listing MLS database in Chicagoland, is arguing for. They're arguing for the seller benefit. So these are two sides of two different coins, right? Or two sides of the same coin. One side is the seller, one side is the buyer. The one side benefits the buyer, the other side benefits the seller. So that's the entire argument. So my point is like, this article here is going to be a survey based on buyers agents' opinions. And they kind of make some comments in regards to the private listing network. I'm not making that's not what this is about, but I am just going to kind of set the stage and make it very clear. It's like there's an argument to be had on all sides. Agree or disagree, this is a little bit biased in the comments when it comes to private listing networks because it's the buyer's perspective. So let's just keep that in perspective. It says 88% of agents say independent representation is in a buyer's interest, but 39% report that they don't see how it benefits agents, revealing the financial incentive behind practices like private listing networks. There's the kind of the dig. But the 88% of agents say independent representation in a buyer's interest. Okay, that's the main point. What they're talking about is dual agency. Most of you guys will know what that is. Some states do not do dual agency, some do. My state does. Basically, just to summarize it up, dual agency is when one agent represents buyer and seller. Okay. The statement here is saying that buyers benefit the most in the buyer's interest is when they have their own independent agent representing them. I mean, not revolutionary concept, right? 88% makes perfect sense. Of course, Individual representation will be better because each party has representation. And I will say, even though dual agency is legal in our state, it is a difficult thing to do. And there is a little bit of a limited amount of representation that the agent can give when they're in a dual agency relationship. It's very difficult to go back and forth. There is a lot of times you end up being a default middleman, just relaying information back and forth, and then specifically asking the client if you can relay the information that you're being told to the other party. So you're just kind of going back and forth that way. So no surprise there, right? It says 86% of agents say buyers deserve access to every listing on the market, yet nearly 1 in 3 don't believe that same access benefits agents. Okay? Again, that's a leaning towards buyer perspective. Previous Zillow research found that sellers who sold to a buyer using the same agent lost a combined $1.49 billion over 3 years, an average loss of roughly $2,165 per home. All right. Sellers who sold to a buyer using the same agent lost. So I would like to know how to quantify that just a little bit. I don't know how they lost money. As a matter of fact, like in our own brokerage, when I look at the numbers, when we have dual representation, which I look at our numbers pretty often, I have found that the commission charged is actually less. So I don't know how they're pulling this, because what ends up happening when an agent in our office typically does a dual agency and they represent both parties, what ends up happening when there's tension in the contract, it's a whole lot easier for that agent to cut their commission to make the deal go through than it is when 2 agents are representing 2 different parties. So on our side, like our typical percentage loss is almost 0.5% lower on average with our dual agency than it is when we have individual representation. So, but that's coming from our brokerage. We have a brokerage of about 300 plus agents and in multiple different markets across the state. So I don't know how this actually correlates, but that's my experience. It might be different for other people. Zillow wants to sell the leads back to the agents, and the big box brokerages want to keep in-house sale. Yeah, that's a good summary, Eric. That's exactly right. It is a feud that we're caught in the middle of, right? Like it's a feud that we're caught in the middle of it. So, and you can agree and disagree on all sides. I mean, there's a part, I understand all arguments. I get it. I understand both arguments. I think there's a benefit to being able to do off-market listings. I think there's also a risk to doing that. I think it should come down to client choice. I think it should come down to client choice in the end. That's who we represent. But when you're proposing any kind of scenario, and this is where I would absolutely agree that the ramifications of choosing to go private listing needs to be completely laid out and spelled out to the seller, so they are completely aware about the risk of doing it that way and the benefits. I think it needs to be completely transparent if they go that route. But that's a whole nother topic. We've talked about that many times here. All right, the dual agency problem. One particularly notable finding is around independent representation. Nearly 9 in 10, 88% of agents say independent representation benefits buyers, while only 61% said it benefits agents, a 27-point gap. This should give buyers pause. The alternative to independent representation is dual agency, which is when a single agent or brokerage represents both buyers. Yeah, we talked about that. This means they control both sides of the transaction and earn a commission from both ends of the deal. The financial return from dual agency for agents or brokerages often exceeds what they earn when each party has independent representation. Therefore, the incentive to keep transactions in-house may run directly counter to the interest of their clients. That is not wrong in a very level area. There is that balancing act. Now, the thing is, and I know some brokerages might do this, but we do not. We don't push or incentivize for dual agency relationships. We don't do that. We encourage if they happen to let it happen, but we do it under instruction about what that actually means. And we help teach and train our agents to do it effectively. But there's no incentivizing of an agent to do that. Yes, there's a monetary gain to that. But we have agents in our own brokerage that would never do it. They sign off and say, we will not do that. So it's if and or, I don't know. The buyer versus agent interest gap is not limited to independent representation. It appeared consistently across every practice the survey examined. Written agreement laying out compensation and services. In buyer's interest, 89%, agent's interest, 86%. Independent representation, 88, 61. Access to all listings on the market, 86, 70. See, and that's where this is where agents would kind of push back and disagree just a little bit. That's my whole point. Is like they're kind of disagreeing with the whole access to all the listings because some of these agents represent sellers too. And this is a buyer's perspective, a buyer survey. And if you're representing the seller, you can make an argument for that it might be beneficial in some cases, in a very limited case, to do an off-market marketing for a little bit. But again, you got to adhere to the rules and regulations of the MLS to do that. Written agreements are the closest to parity. 89% of agents said they benefit buyers. 86% said they benefit agents, suggesting agency value in the clarity and protection they provide to all parties. Across the board, alignment breaks down on practices that directly affect agent compensation or control, including the right to choose, the right to negotiate, and the right to see all available homes. The gap was widest on commission negotiation. 77% of agents said buyers being able to negotiate fees in a buyer's interest. Only 46% said the same of their own interest, a 32-point spread. Here's the thing, guys. Anybody out there knows this. Commissions have always been negotiable. We've negotiated commissions for centuries, guys. Like, come on. I mean, it doesn't mean the agent has to give a break, but it's a negotiable number. It is a negotiable number. And the agent can decide to do it or not do it. All right. Anyway, that is literally... That was it. It popped up. Quick discussion about it. Nothing major. All right. Now we're going to have a little bit of fun. Like I said at the very beginning of the show, the last article I was going to cover was just about having fun. And it's an article that popped up about looking at the extraordinary real estate of the founding fathers would be worth hundreds of millions today. So it's looking at the old homes of previous founding fathers homes and the value what they bring. So this is gonna be kind of fun. If the founding fathers were alive today, they'd probably have a lot to say. They'd also be very rich. They'd be very rich. That's because many framers of the Constitution owned some spectacular real estate. And if these properties were currently on the market, they would command a pretty penny, while also possibly being pictured on the back of a nickel. From George Washington's Mount Vernon estate to Alexander Hamilton's Manhattan home known as the Grange, these homes are iconic pieces of American history that deserve to remain held in the public trust in perpetuity to educate and inspire future generations. But if they did hit the market, how much would these homes sell for today? The truth is, it's almost impossible to exactly pinpoint what they would go for on the open market, as there are no true comparable sales to consider. As a purely hypothetical exercise in honor of America's 250th birthday, some of the nation's top historic home valuation experts have agreed to share their insights on what these pieces of American history might fetch if they were on sale were for sale in this century. So here's the thing, like I've not actually been to these homes. We were in Washington, D.C. doing sightseeing and that kind of stuff. We didn't have time to get over to Washington's home, Mount Vernon. I wanted to do it, but man, it's hard to squeeze everything in Washington, D.C. If you've not been, go. It's actually not that expensive of a trip at all. You can see everything almost for free. Very few things you have to pay to see. But anyway, should go see it though. All right. What makes these difficult to value is there's nothing to compare them to, says Doug Van Soest, a co-owner of SoCal Home Buyers who has also worked as a certified residential appraiser. No appraiser has 3 sales of a founding father's house on the same block to work from. So you back into it instead. What's the land worth? What would it cost to rebuild the structure? And then you sit there guessing at what the dame adds. So this is hypothetical, guys. This is for fun, okay? You've got premium land plus a story that is irreplaceable. That combination is where the price stops behaving like normal real estate and starts escalating very quickly. That is Mount Vernon, the home of former President George Washington, is seen above. That's what this image is. Even if they didn't have the name value, however, these homes would still be worth a fortune today. These homes are truly impossible to value in the traditional sense, says Erica Colicco-Swink, an associate broker with Max Brock Realtors in Detroit, who has 2 decades of experience specializing in architecturally significant and historic homes. There are no comparable sales for a founding father's estate. So we get the idea. Eric, thank you for following, my friend. Appreciate that greatly. Thank you. Thank you for being here. I do appreciate you guys you contributing to, and show me that website. I'm going to check that out, man. I really am. All right, Mount Vernon, former home of George Washington. Though Mount Vernon began as a modest 1.5-story home built by Augustine Washington in 1734, When George Washington inherited it 20 years later, he began turning it into what would eventually become a spectacular Virginia mansion. Over the course of 45 years, George, who was very involved in all aspects of the design, construction, and decoration, built out Mount Vernon until it was approximately 11,000 square feet, 21 rooms, sitting on over 7,600 acres of land. Holy moly! Are you kidding me? In other words, an estate worthy of the nation's first president. That is crazy amount of land. All right. Today, Mount Vernon sits on roughly 500 preserved acres of prime Virginia property overlooking the Potomac River. And thanks to its size and location, Potomac. And thanks to its size and location, it'll be worth a small fortune. 500 acres is still a lot of land. Mount Vernon is in a league of its own, says Schwenk. Without the historical significance, you're still talking about an incredible waterfront estate outside Washington, D.C., with hundreds of acres, which could easily command $100 million to $150 million in today's luxury market. Smith agrees that the property alone would be worth around $75 million to $100 million. That's a half a square mile of some of the most valuable real estate in the country. Add in that it belonged to one of the most iconic names in American history, and I would think if this was on the market, we're talking $483,775,000 at least. There you go. $500 million, guys, if you want to buy it. It's not for sale. Northern Virginia has definitely demonstrated that it's an active trophy estate market, with Potomac waterfront properties recently being offered in the 20 to 30 million range or more. All right. Monticello, former home of Thomas Jefferson. Though also located in Virginia, Monticello, the former home of Thomas Jefferson, would likely not pull in the same prices as Mount Vernon, but it still would command a hefty price. Monticello is approximately 11,000 square feet, which is the same size as Mount Vernon, with 43 rooms, which I think he said is 21, right? Is that right? 21 rooms? Yeah, 21 rooms in Mount Vernon, 43 rooms in Monticello. And today sits with roughly 2,500 preserved acres overlooking Charlottesville, Virginia. So it still sits on 2,500 acres. Whew. If Monticello were simply an extraordinary private estate with no association to Thomas Jefferson, it would still rank among the most remarkable residential properties in Virginia, says Barker. Charlottesville does not have the same ultra-luxury market level as Northern Virginia, but a private estate combining these characteristics could occupy or exceed the upper end of Virginia's luxury residential market and command a value well into the 8-figure range. Van Soest agrees that Monticello would come in at a lower valuation than Mount Vernon simply because Charlottesville doesn't carry Fairfax County land prices and has a different footprint. Most of those 2,500 acres are woods and farmland, and though Jefferson designed the house himself, it wasn't built to live in the way a buyer wants now, says Van Soest, who would guesstimate Monticello would land somewhere in the 50 million to 100 million range. It's also a UNESCO site, and the house is on the back of the nickel, which is not the kind of thing that shows up on any appraisal I've ever filled out. If Monticello were simply an extraordinary estate in Charlottesville with the acreage, architecture, and improvements, I'd estimate somewhere in the 75 million to 125 million range, says Swink. Once you factor in that fact that it was Thomas Jefferson's home and one of the most significant properties in American history, I honestly think it moves beyond what traditional market value can measure. And this is the last one, and we're going to wrap up, guys. Got 2 minutes left. Old house at Peace Field, former home of John Adams. Moving up north a bit, John Adams' home located in the outskirts of Boston, Massachusetts, which he lovingly called the Old House at Peacefield, seems more modest in relation to the southern estates. However, it would still sell for a bundle today. The Adams family home is located in Quincy, Massachusetts, a smaller market outside Boston, where, according to Van Soest, regular single-family homes trade in the mid-700s. So, on paper, you're looking at maybe a $2 to $4 million house. But that's before you add in its history bump. Though it's down to 5 acres now, from the 75-acre farm Adams bought in 1787, nobody cutting a check at the top end is pulling Quincy comps. What they're really buying is two presidents under one roof, founding father John Adams and later John Quincy Adams, and 4 generations of the same family after them. That's a lot of history. That's a huge amount of history. Who adds that of the founding fathers' properties, this is the one place where the name outruns the building. It's not that impressive, but it's just an old house. The old house at Peace Field, built in 1731 for a sugar planter as a summer home. It was purchased by the John Adams in 1787, and it was occupied by the Adams family till 1927. So huge amount of years. As a normal state, Smith says he thinks this Georgian mansion on 13 acres would go for around $6 million, but with the history tax, he put it around $40 million. The biggest draw here is the dynasty, and it's more about owning the home of the entire American founding family. Swink also imagines someone looking to acquire this property would be seeking authenticity, since it has a quieter kind of significance. Buyers that look at homes like this aren't chasing trends. They're looking for a craftsmanship history and property that's been thoughtfully preserved. R. Ingram, thank you for the follow. Appreciate it greatly. Thank you for being here and checking out the live stream. Thank you. Appreciate that greatly. Oh, there is one more home here. Sorry, I thought we were done. I gotta hurry. I'm running out of time. All right. Hamilton Grange, former home of Alexander Hamilton, guys. Alexander Hamilton didn't throw away his shot when it came to acquiring property in Manhattan. And with the going price of real estate in New York City, not to mention his recent Broadway musical fame, Hamilton Grange, his former home would sell for millions of dollars today. Unlike Mount Vernon and Monticello, Hamilton Grange derives much of its modern value from its Manhattan location rather than extensive acreage, says Barker. The home itself is considerably smaller, but it occupies one of the strongest real estate markets in the world, where buyers are willing to pay tens of millions of dollars for exceptional townhomes and historically significant residences. Just the house itself, a federal place around 5,000 square feet, might run $4 to $7 million today, as restored townhouses in Upper Manhattan go for about $950 per square foot, according to Van Soest. But while the current Hamilton Grange home sits on 3 acres, Alexander Hamilton could have been even richer if he'd kept all the property he once snapped up. Hamilton is one that gets me. He picked up 32 acres in what's now Hamilton Heights in 1800, 32 acres of Manhattan. Price that original footprint as raw Manhattan land, and you're into the hundreds of millions, probably past $1 billion. The building's almost a rounding error next to the ground it's set on. Holy moly, guys, that's wild. Smith agrees that because the house is smaller and it's federal-style old home as a normal property, the main value comes from the lot. With the land, it makes it incredibly more valuable, says Smith. My guesstimate would be that the land could sell around $50 million and fairly quickly, given the fact that right down the road, a 7,491 square foot lot is up for sale for $6.5 million. Wow. The bottom line with all the Founding Fathers' homes is that these men would have been very wealthy in today's real estate market. At the end of the day, the market still determines value. But when you're talking about iconic historic properties, value goes well beyond square footage or the number of bedrooms, says Schwink. You're talking about something that can never truly be replicated. That was fun, wasn't it? Did you guys enjoy that? I found that article. I was like, this would be fun to just kind of talk about. Guys, I am way out of time. I will be back here tomorrow morning, 8:30 a.m. Eastern time for another live stream. Please join me where you're watching me now. It's been great. Thank you guys for the follow. The follows, Eric and Ingram. I appreciate you guys being there. Thank you for those that have contributed, Richard and Eric and Kevin, everybody else that has talked in the chat and all that kind of stuff. I missed everybody. I am so sorry. But thank you guys for being here and staying for the show. I greatly appreciate that. I do not take that for granted. My goal is when I do this to provide something value back to you guys and help you guys succeed in real estate. So hopefully I am, fulfilling that promise to you guys. So I do appreciate it greatly. That is your real estate brief for today. If you found this helpful, please consider hitting the like button to tell YouTube you would like to see more of this type of content, and consider subscribing and follow me on TikTok to join a community of real estate agents that are focused on building business that is relationship focused first. There's more I could be talking about. That's what we're going to do tomorrow. We'll see you then, 8:30 a.m. Eastern time, where you're watching me now. Take care. Have a great day. Eric, thank you again. Awesome. Appreciate it. Have a good one.